welcome. You're watching The Money Show. I'm with you, Kavita Thapliyal, and in today's edition of Money Show, we'll be talking about taxes on your investments. So, we do like to invest in different asset classes, be it equity, fixed income, real estate, gold, crypto. But do you really know what's the tax treatment on your investment? A lot of investors do not consider that, and even if they used to, it was mostly when you were in the old tax regime where you just thought about the tax benefits. Insurance, for that matter, a lot of people just invest money in it, in insurance investment products, but aren't really aware of the tax treatment that might impact when they are withdrawing that money or redeeming that investment. So today we are going to break it down asset class wise and help you understand the tax treatment on each asset class, on each investment instrument, and we'll help you try and strategize the best strategy where the burden of your taxes is actually less on your investment, and what could be the smarter ways or those very simple tax saving hacks. I have with me Tarun Garg from Deloitte, who will be helping us with this entire topic today, and a very interesting topic, Tarun, because a lot of time when I have questions on my personal finance show, which is The Money Show, a lot of time investors are not aware, because mostly we'll talk about mutual funds and SIP, that they do via mutual funds. They are really not aware about the tax treatment, which is in a way not really good if you are investing in any kind of investment product. Not only the return should be your concern, but also the tax treatment on the return that you earn. So let's take it asset class wise. Let's just first talk about the most popular investment instrument, fixed deposit. I want to begin with that.
Thank you, and thank you so much, Kavita, for calling me on the show. And good afternoon to all the listeners and all the viewers. So, see, Kavita, very important question that you've raised on the fixed income assets. So, see, fixed deposits are the really kind of a safest mode of investments, because people earn a fixed percent of interest over them. Now, from a taxation perspective, like what interest is taxable? So generally what we see is that if you've deposited your money, then whatever interest that you're earning on those fixed deposit, that is clearly kind of taxable under the head other sources income. So as such, on fixed deposits there is no sort of a deduction is available, and when we talk about the new tax regime, as such no other benefit or deduction is available. The only benefit is that the lower rate of taxation is triggered. So clearly on the fixed deposits, whatever is the interest that is earned, that has to be declared by the assessing the return of income, and clearly that will be taxable as per the slab rates. So Kavita, that's the overall treatment. And lots of times what we have seen is the senior citizens do prefer to deposit a lot of their money into fixed assets and these fixed deposits. So clearly fully taxable in that interest income. Yeah.
All right, but then they aren't aware about the tax treatment most of the times. That in the interaction that I get to know, I think what's the priority over there is safety and security. They know that their entire life saving is there secured. Anyways, there is risk involved over there also, but that's the aspect of our financial planning discussion if we reach there on the show today. But then having said that, so this is one of fixed income that we are talking about, which is fixed deposit. There are other fixed income instruments also where people can invest, where specifically they have a fixed coupon rate that they get on their investment. So if you could just highlight those investment instruments and the tax treatment on those.
Sure, Kavita. See, what happens is also there are a lot of times people do invest into bonds, debentures, and various sort of other instruments that are kind of called upon by the companies and wherein they give surety that whatever are the investments public are making, they'll give say 10%, 11% as a fixed rate of interest. But then these instruments are slightly higher in the risk category as compared to the fixed deposits which are parked with the banks. So, but when we talk about the tax treatment, clearly interest generated out of these instruments is clearly taxable in the year when these interests is received. and the categorization of income is the income under the head other sources. So clearly this has to be reported by the individuals when while filing the return of income, and we know that for financial year 24-25, the return deadline has been extended to 15th of September. So if any person has received such income in the financial year that closed on 31st of March 2025, then certainly this has to be reported as other sources, and it will be taxable as per the slab rates that they fall in. Yeah.
All right. So we are also talking about debt mutual funds over here. That also comes in the category of fixed income. The tax implication over there and the edge above all those fixed income instruments that you just mentioned.
Correct. So see, debt mutual fund, if these are kind of sold, then definitely these one do give a certain percentage of benefits to the taxpayers, and clearly will be taxable in their hands as again income under the head of the sources. But one point to be noted about debt mutual funds is that gain shall be taxable fully, and that gains shall can all either be a short term capital gain if these are sold say prior to 24 months, and if these are sold after 24 months of holding period, the gain shall be categorized as a long term capital gain. Now from a tax rate perspective, the tax rate is again on a short term mutual fund. If these are sold, then that tax rate is 20%, and on the long-term capital gain is 12.5%, because that was changed by budget 2024. That was announced in that had came in July 2024. So with those, the new effective tax rates have been kicked in for the capital gains.
All
Yeah.
right. So now when we talk about debt mutual funds, Tarun, there are 16 categories of debt mutual fund depending on the kind of time duration you want to stay invested for. So we're talking about short term and long term for all duration, because in a debt mutual fund we also have an option to park money for 24 hours. You know, in a liquid fund or an
Yes,
ultra
yes,
short
yes.
term, ultra short term. So what are tax implications in those scenarios then?
So see, these have now been mandated that all these funds, if these are debt mutual funds, will be categorized as a short-term investments, and short-term capital gains will kick in for them mandatorily. And the tax rate on such short-term mutual funds will be say 20%. So that is that there, and broadly I think in some of the categories the slab rates shall also get kicked in. So clearly one has to kind of see what is the kind of rate of return that is getting generated out of it. Otherwise the tax rates are higher in such instruments as compared to say when we talk about equity funds, or say other investments. If we talk about even on some of these equity oriented mutual funds, the tax rates are slightly lower, and equity shares also the tax rates is comparatively lower.
All right. So when we talk about fixed income, and since we've covered most of them, or at least the ones which people usually prefer, let's talk about gold, because that's the other popular and most favorite investment instrument. I'm talking about physical gold and also holding gold as an investment through various other routes, you know, maybe a mutual fund or ETF. So I would like you to explain tax implications on all of these kind of holdings of gold.
So yeah, so see, as a matter of again, one of the safest investment is gold. So in gold, preferably what we see in the families, people do prefer to keep them as ornaments, or as a say as a hard sort of a gold without kind of converting into ornaments. So when we kind of invest into gold, till the time those investments are not sold or liquidated, then that's an unrealized gain. So those those unrealized gain are not taxable. But at any point in time, if those assets are liquidated and whatever the proceeds are generated, then depending upon the period of holding, and that will be kind of considered as either a short term gain or a long term gain. Clearly, if the gold has been held for 24 say months or more, then that gain will be a long term capital gain, taxable at 12.5%. The indexation benefit has been taken away. And if that gold has been held for lesser than 24 months, clearly a short term capital gain, and the tax rate is 20% there. Now, you also talked about, Kavita, the exchange traded golds, ETFs and all. So again, the tax rates is very similar on them. So the sale consideration less the proceeds, or that's also called as proceeds, and the investments that the person has made. So cost of acquisition will be deducted from the sale consideration, and then whatever gain that is arrived at, it shall be considered as a short term or a long term, depending upon the period of holding.
So now, since
Kavita.
we've spoken about debt mutual funds, other classes of other investment instruments in fixed income. We've spoken about gold. Let me come to a category which is a multi-asset allocation category. Which is again it comes under the hybrid aspect of mutual funds. The reason why I'm asking you is because it has debt in it, it has gold in it, it has equity in it. So what kind of tax treatment does multi-asset allocation funds really have? Because investors are really interested in this category these days. We are seeing AMCs launching these kind of multi-asset allocation funds. But having said that, the equity portion in most of these funds is still heavy. After that, it's debt and it's fixed income, and then we have gold, silver, and a little bit of REITs or InvITs, that they might have. So ideally, what will be the tax treatment, considering you have so many asset classes in this kind of a fund category?
So typically, see, this depends upon the percentage that these hybrid assets carry. While no kind of a specific formula, but again, some principles or directional inputs that are there are, if any hybrid asset is carrying up to, I think, 35% of debt in it, then that will be still considered as an equity heavy fund, and it's called as an equity oriented fund. Then again, considering the heavy portion of equity there in, Kavita, still these will be categorized and taxed just like your equity shares. So if you have invested, stayed invested in them for say 12 months, or more, then these will be categorized as a long-term holdings, and accordingly the percentage of tax will be 12.5%. And if the holding period is lesser than 12 months in such mutual funds, then it will be a short-term gain taxable at 20%. Now, on the other hand, if the debt portion in such hybrid assets is higher than 35%, then these will be categorized as a debt oriented funds, because it has slightly higher kind of a debt instrument there. Then again, the taxable treatment will become a little different. So then these will be treated as a long term asset if the investment has been 24 months or more, and a short term asset if the investment has been lesser than 24 months, and the tax rates are same. For short term, the tax rate is 20%, and long term asset, the tax rate is 12.5%.
Uh, is there any indexation benefit in the multi-asset allocation category? I know it's been taken away from debt mutual funds, which is why it has become at par with fixed deposit, because otherwise there was always an edge, of investing
Yes.
for investing in debt mutual fund. But what about the indexation benefit when you're investing in a multi-asset allocation fund?
So, Kavita, see, budget 2024 has clarified, and they've said that all primarily on all the assets, the indexation benefit has been taken away. Only one asset where you can still enjoy and avail the indexation benefit is only in case of your land and buildings, and that too if you have purchased those land buildings prior to 23rd of July 2024. There you can still, as a resident individual, you can still avail the indexation benefit depending upon the gain that you have. So if you are sort of after indexation, and typically what we see is there were lots of price fluctuation during this period, COVID period. Somebody have sort of sold or bought those assets and now they are selling. The price have not increased significantly in certain areas, specific area, and that was the reason there was a lot of hue and cry on that, and that's why the government had changed the language in the budget, final budget, and when they drafted that act, they retained the indexation benefit only on land and buildings, but otherwise it has been taken away even on hybrid assets and other kind of categories of assets, Kavita.
All right. Now, since land and property has come in the conversation, let's talk about investing in real estate.
Sure.
Yeah, so the tax treatment on selling a real estate or once you buy it as well. So there has been changes again in this particular asset class.
Yes, yes. So a lot of changes again, and what we hear, and a lot of times there are queries from NRI people also. So I'll just try to cover if both the scenarios. If you are an individual, you're resident in India, and you're staying in India, or if you are an NRI, you have still kind of hold some of the properties in India, and then you're selling. So let me just try and come to the for the individuals who are in India and have invested into land and buildings and they're selling. So the general principle is that, like, if you've bought a property prior to 23rd July 2024, on or before basically 23 July 2024, and then you're selling it later, you still have that option of indexation. So there are, and depending upon the time duration you are of holding those properties. So if you've held them say for 2 years or more, then these will be treated as long-term asset. And if you have held them for lesser than 2 year period, then these will be categorized as short-term assets. And the tax rate on long-term sale is 12.5%, and short-term is 20%. Now these are also subject to the applicable surcharge and cess rates. So those has to be kind of considered in mind. One important aspect to note is indexation is only available if the property purchases prior to 23rd of July 2024. Otherwise, broadly, if you've purchased the property later than this date and you're selling, that indexation benefit will not be available. Now, a lot of time NRIs also raise this question that, hey, look, I have purchased my property, purchased my property in India now, and I've held, and even my parents have transferred those properties via will, and they've kind of I've got those property as inherited also. Now what will be the treatment in my case if I have sold them? Now I'll want to kind of explain that this benefit of indexation is only retained for a resident individual. So if you are an NRI, then again you will be mandated to pay 12.5% on such assets sale, assuming that you have hold them for say more than 2 years, and even the holding period of your parent will be added because you have inherited that from the previous owner. So in that case, there's a mandatory 12.5% of long-term capital gain that will be applicable, and there will be no sort of indexation benefit. So clearly, the sale consideration less the cost of acquisition and cost to the previous owner shall be considered. But one thing that you can still avail the benefit is you can take the rates basis the revised sort of circle rates and all, and you can take that claim of 2001, because that was the time when the even the cost inflation indexes were kind of changed, and that rate was considered as 100 for cost inflation index, Kavita.
All right, perfect. A very important asset class, real estate, and unless and until you really go and buy it, people don't understand the taxation or the tax implications involved over here. But having said that, let's move to another very favorite category, which is stocks and mutual funds or equity. So standard taxation if you buy a stock or a mutual fund, or are they different?
So I'll say a slight sort of a difference, but
Sure.
broadly, I think the treatments are the same. So for equity and even say what happens if you are one needs to kind of consider is whether it is a listed share or an unlisted share. So for listed share, clearly that 12-month category is there. So if you have invested into equity, selling them after 12 months, then clearly the gains shall be considered as a long-term gain, taxable at 12.5%, assuming you have purchased those or sold those assets after, say, that 23rd of July 2024. And then similarly, if the short-term gains will kick in if you are holding them for lesser than 12 months, and the tax rate is 20%. Now, coming to unlisted shares have a slightly different holding period. There, the 24 months holding period is to be considered. So if these unlisted shares are held for lesser than 24 months, then these shall be considered as short-term asset, taxable at 20%. And if these are held for longer than that tenure, these will be considered as a long-term asset and long-term gain, taxable at 12.5% rate. The mutual funds also work in a similar way, but then one has to see that is it a equity oriented fund or a debt oriented mutual fund. The taxation slightly varies over there, and that we had already discussed, Kavita. Yeah.
I also want to talk about the taxation implication involved on crypto. It is we don't have a legal framework around it yet, but having said that, there is tax on it as well once you book profit, or even you can set it off if you have a loss.
Correct, correct. So very important, and it's a one of the popular sort of investment. And what the even studies have shown, despite not having India not having a legal framework, people prefer investing in, and that was the reason a new section 115 BBH was introduced, and thereby this section clearly kind of calls out that all the gains from crypto shall be taxable, and the only sort of say deduction or you can kind of reduce is that the value on which you have bought those crypto. So clearly these will be considered as a short-term sort of assets and all, or short-term gains, and there will be no sort of indexation benefit. The tax rate is the highest rate of 30%. So how the taxation works on crypto is whatever is the sale proceeds from those designated security platform that you've bought them, less the cost of those acquisition of those assets, whatever is the remainder gain that is there, you have to offer that to tax, and that the tax rate is clearly 30%. One important aspect to note over here is this crypto loss cannot be set off against any other sort of losses and all. So if your the sale consideration is lesser than the cost of acquisition, so that loss you cannot carry it forward for the future years, and the only sort of that loss can be set off if you have, say, for other say if you have gain in Bitcoin but loss in, say, Ethereum or so, then those losses and gains can be set off. But otherwise you cannot just set off the loss from crypto against any other assets, and the tax rate is a flat 30% on the gain, Kavita.
What about setting off your losses in other investment instruments that we just discussed? Is that possible?
See, losses, yes. So, in other instruments, say if I say equity, debt, and mutual funds and all, or foreign shares, if you are having a loss on that, then clearly, yes, you can set off against other, say, other types of gains and all. That is possible, but it depends upon what is the category of that gain. So any long-term loss can only be set off against the long-term gain. But if you are having a short term loss, that can be set off against the long term gain. The reason for this is the long term gain is taxable at a lesser percentage as compared to the short term gain. So that is why there is a distinction in the income tax act that they have created. So only losses from short term can be set off against gains from the short term. But if you have losses from long term, that can be set off against gains either from the long term or from the short term as well.
All right. One last question before I let you go. Any quick tax saving hacks for our viewers?
See, now with the new tax regime, as such, there are sort of very limited hacks, I would say. But then, what has been a real popular scenario, and I'm kind of, I'll distinguish this for the salaried class and for the others. So, for salaried class, a lot of times what we are seeing is car leases are very popular. And even the employee purchase program. So, just like your mobiles, laptops, iPads, iPhones, all those watches and all. So these are getting a lot of popularity, and there are vendors out in the market that are kind of introducing. And the concept for that is that even the government provides smartphones to the employees to improve the efficiency, because in today's world you can't open laptop all the time, so you have to have those handheld phones to so that you can work on. And the way it works is basis the salary sacrifice model. So it is deducted out of your CTC, but it is shown that as the employer paying this money directly to the lesser. So that's how that salary sacrifice model works. And clearly it is coming out of your pre-tax salary. So whatever iPhone that is costing you, say 1 lakh, if you are purchasing it from your post-tax salary, if on the salary sacrifice model, if you reduce the tax burden on it, that is costing us 70,000. So that are the only couple of options under the new tax regime for the salaried class. But for other investors, I would say just try and kind of see if you are having some losses in your assets, and these are and despite having invested for so long, these are not getting recovered. Try and set off against the gains where you are where you have achieved the target price for those securities and you are bound to sell them. Then those losses can be set off against those gains, and then you will end up paying the lesser taxes. So these are some of the, I would say, investing hacks, Kavita, that one can avail.
Think, we are short on time, but then thank you so much. You know, within this time frame, you could actually talk about a lot of, in fact, all the asset classes, and also help our viewers frame their strategies right as far as tax implication on asset classes is concerned. Thank you so much for being on the show today, Tarun. Thanks.
Thank you, Kavita. Pleasure always. Thanks. Bye.
Bye. So for all the viewers, I'm going to leave you with our WhatsApp number and email ID, just in case you want any clarity or you want to strategize your investment strategies right as far as taxation is concerned, or any of your investments. Do send across your questions and we'll have it answered by our experts. Thank you so much for watching. Goodbye.